Hello, ladies and gentlemen. Welcome once more to the Financial Times headquarters for the latest in our PWM expert series of videos made in conjunction with BNP Paribas. Now, with my guest, Jacky Prudhomme, we will discuss changing trends in ESG investing. Have we seen a huge change in the development of this sector, which once concentrated on avoiding investments in arms and tobacco and now looks at a much broader range of different factors?
Yes, the market is changing, is evolving. Traditionally, we used to link the responsible investment with some negative screenings. You do exclude some companies. It was more what we could call ethical investment because you get rid of some sectors that are very controversial. You have been mentioning, Yuri, alcohol, tobacco, gambling. It's still a big part of the business, especially in the Anglo-Saxon world, but what we have been witnessing over the last 5 to 10 years is that there is now a growing shift towards positive screening. Investors want you to invest in the most promising companies, so the most robust companies. It means for us, the companies that manage the best way their ESG impacts. Now the big trend is more about, first, I want to protect my clients, so institutional clients, from reputational risks. Now we are at the age of the internet. All the controversies are made public at the very second they happen. So they don't want to invest in some companies that are just making the big buzz in the media for the negative impact of their activity. They also need to demonstrate they are part of the solutions for a changing world. We have big challenges to be faced in our societies. It's now also a new role for institutional investors to be active in changing our societies in a positive way. And that's the reason why the ESG part now is more into the positive, investment. We want to concentrate our investment in the companies that are part of the solution, that do provide the best products and services, and on the opposite, we don't want to invest in the companies that are still stuck into the, old-fashioned way of managing businesses.
But at the same time, do you feel investors' mindsets have moved from an ethical viewpoint to one which is thinking much more about risks and corporate governance of companies and their compliance with regulations?
Definitely. It's very, very obvious. You have now big pension funds, you got big institutional investors that are exploring how ESG could help them safeguard their assets. And they are comfortable with the fact that now we have been, in the industry, we have been very active on using ESG for more than a decade, so they are happy with the demonstration that there is value to be found in the ESG dimensions, and integrating ESG into the portfolio is something that is now relevant. We know that in Europe, at least, there is a sort of big agenda to promote long-term investing, and it appears that one part of long-term investing is favoring responsible investment. Is really a change of mindset. It is now also to be transparent to your own clients, to your own trustees, that you have been making efforts implementing ESG. All the consultants in the place, all the investors now are asking companies to provide, to demonstrate they have the capacity to integrate ESG. And they also want now to be transparent because in the near future, all the asset owners will be, required to disclose some carbon footprint of their investment, of their portfolios. It will be maybe one day the same thing for their social impact. So it means there is a closer relationship with the asset managers on how to make a better reporting on all these issues.